Newsbreak sources tell us that India's largest car maker, Maruti Suzuki, has started looking for a land parcel to build a new facility, a new plant. Now, the company has written to the Haryana government asking for a land parcel. Uttkarsh Chaturvedi joins us with more details for that story. Uttkarsh, what else are you picking up?
So our sources indicate that Maruti has not only asked for any land in the state, but has written demanding a 1,200-acre land parcel in Sona, Haryana. Now, this land parcel is very close to the current Gurugram plant of the company. Now, what is the interest which Maruti has in this particular land parcel? One, the company does not want to plant away from its existing two plants, as the auto component makers supply parts to both of these plants from the same component plant they have. And Maruti does not want its supplier to set up another facility, as they might lose the cost effectiveness. Now, speaking about the second one, and most importantly, the company has proposed to move the manufacturing from the current Gurugram plant to the new facility once the plant gets functional in its first phase. Now, sources indicate us that the current Gurugram plant now falls right in the center of the city, and logistics and movement of goods has become a time-taking process given heavy traffic in the city. But the Haryana government is yet to take a call on the proposal of the company. Now, the issue here is that the state policy does not allow allotment of land but an auction of the same. Maruti, however, is not willing to participate in the auction and has asked the government to allot the land at a fair price. Sources also indicate that the company chairman R.C. Bhargava has already met the Haryana CM and other state officials requesting the same. When we reached out to Maruti for an official comment, the company has said that they will not be able to comment on this subject.
Right, Uttkarsh, thanks a lot for that. So clearly, the allotment versus the auction debate confronting the Haryana government on the demand of Maruti for fresh land. On that note, let's switch focus now from the insurance space. An exclusive CNBC-TV18 story. The insurance regulator, IRDA, in consultation with SEBI, is all set to revamp IPO rules for insurance companies. Sources in the know tell us that the regulator may reduce the portion reserved for QIBs or qualified institutional buyers from the current 50% level. Yash Jain, who has been tracking that story, now joins us with more details. Yash, tell us, what are you picking up?
Well, absolutely. The insurance regulator has reached out to SEBI suggesting certain changes and amendments with respect to IPO regulations for insurance companies. To start with the first one, and this is with respect to diversifying and broad-basing the shareholding reservation pattern for the insurance IPOs. Here, essentially to reduce the concentration of risk and broad-base the shareholding reservation pattern, IRDA is likely to have suggested to reduce the QIB portion in any insurance IPO from the current point of 50%, and essentially then later on that reduced portion out of the QIB section should be distributed amongst the various other shareholding categories, be it retail, be it HNI, so on and so forth. The second and the most important point is with respect to the minimum public shareholding norms. Of course, we know that all the listed companies are essentially mandated to dilute 25% of equity in public within 3 years of listing. IRDA here has said that it's not likely and it's not ideal for any insurance company to transfer 25% of the risk in public within that short period of 3 years. Hence, a time extension should be given to the insurance companies as far as that particular dilution of 25% is concerned. If not a time extension, then the quantum of 25% should be reduced. If this particular point materializes in terms of any regulation, and if it is retrospective, then it will benefit a lot of these listed insurance companies, be it ICICI Prudential Life, be it GICRE, be it New India Assurance, as well as SBI Life and HDFC Life, as all these companies have a significant quantum which they are yet to dilute into the market to comply with that 25% public shareholding norm. The third one is with respect to raising debt via Tier 2 bonds. Right now, insurance companies are only allowed to raise up to 25% of their net worth via Tier 2 bonds. IRDA here has suggested to raise this particular limit, possibly take it to 40 to 45% of any insurance company's net worth.
Right, Yash, thanks a lot for that. Now on to news coming in from Kerala. The 43-year-old nun who had accused the Bishop of Jalandhar, Franco Mulakal, of raping her has now written a letter to Vatican's India ambassador seeking help. She has accused the church officials of ignoring her complaints. In her letter, she has listed the names of those who she had asked for help. A special team probing the case has told the Kerala court that the bishop had allegedly abused his position and repeatedly raped the nun. Meanwhile, the bishop had rejected the charges as baseless and concocted. He has also said that he's open for a probe.